$45 billion in equity investments in less than half a year. That's not a company diversifying. That's a company trying to own an entire industry from the ground up. Nvidia isn't just building GPUs anymore. They're buying the fiber that connects them, the data centers that run them, and the cloud companies that sell access to them. 6 companies, billions of dollars each. And by the end of this video, you'll know exactly what Nvidia is building and whether you should be investing alongside them. Let's get into it. Before we get into individual companies, you need to understand the master plan. Nvidia isn't doing this for financial returns on equity, they're doing it to build a moat. There are 3 layers. First, lock in the optical supply chain so competitors can't get the fiber and photonics needed to build AI systems. Second, invest in neo-cloud operators who will deploy billions of dollars of Nvidia hardware. And third, create a self-reinforcing ecosystem where Nvidia is simultaneously the investor, the equipment supplier, and a customer. It's genius and slightly terrifying. Let's break it down company by company. Company number 1, Corning, a 175-year-old glassmaker and suddenly the hottest name in AI infrastructure. Nvidia committed up to $3.2 billion in May 2026 with $500 million up front as a pre-funded warrant. Here's the deal. Corning is building 3 brand new factories in North Carolina and Texas to produce fiber optic cables exclusively for Nvidia. We're talking a 10x increase in US optical manufacturing capacity. Why? Because Nvidia is replacing the copper cables inside its AI rack systems with Corning's glass fiber, and that fiber uses 20 times less power than copper. At gigawatt scale, that's a game changer. The stock already jumped 12% on the announcement. The risk? It's already up 112% year to date with a 51x forward PE, so a lot of the good news is priced in. Lumentum, ticker LIGHT. And let me tell you, it is anything but light on performance, up 1,269% in 1 year. Nvidia dropped $2 billion here in March, plus a massive multi-year purchase commitment. Lumentum makes laser components and silicon photonics, the stuff that powers next-gen data center connectivity. Their most recent quarter, 90% revenue growth. Fiscal Q4 guidance, over $1 billion. And here's the kicker. Supply-demand imbalances are exceeding 30%, meaning Lumentum can basically name its price right now. Wall Street price targets range from $900 to $1,200. The risk is valuation. After a monster run, the stock trades at about 159x forward earnings. But if you believe AI data center build-out is a multi-year supercycle, and the evidence strongly says it is, Lumentum sits directly at the bottleneck. Next up, Coherent. Also got $2 billion from Nvidia in March. If Lumentum is the high-octane growth play, Coherent is the steady compounder. Revenue of $1.81 billion last quarter, up 21% year over year, and they've beaten earnings 4 consecutive quarters in a row. Here's the key differentiator. Coherent has 20 to 30% of the global transceiver market. That's not niche. That's the dominant supplier for 800G and 1.6T optical modules, which are the next generation standard. They just got added to the S&P 500, which means passive index funds have to buy the stock. And their new 6-inch fabrication facility just shipped its first transceiver, which is a margin expansion catalyst. The drag is their industrial segment is still down 16% year over year. That's holding them back compared to pure play AI names, but the trajectory is clear. Iron is the wildest transformation story in this entire group. This company was a Bitcoin miner. Now they've got a $9.7 billion Microsoft contract, a $3.4 billion Nvidia AI cloud contract, and they're deploying 150,000 Nvidia GPUs. They've secured over 4.5 gigawatts of power, which is an incredibly scarce resource, and they're targeting $3.7 billion in annualized recurring revenue by end of 2026. Nvidia granted them a 5-gigawatt strategic partnership, meaning Iron will deploy Nvidia's architecture at a massive global scale. The stock up 657% in 1 year. But they're at real risk. They're burning heavy capex, EPS is declining near term, and the pivot still needs to execute. But those long-duration contracts from Microsoft and Nvidia are a serious foundation. CoreWeave, the most controversial name on this list. Nvidia put in $2 billion in January at $87.20 per share. CoreWeave was an Ethereum mining company, retooled its GPUs for AI, and is now the largest neo-cloud operator by revenue. $2.1 billion in Q1 2026 revenue alone, up 112% year over year. but they lost $740 million in that same quarter, and their debt-to-equity ratio is 10.7 times. 10.7. That is extremely leveraged. Here's the structural issue. Nvidia is simultaneously CoreWeave's biggest investor, their primary hardware supplier, and through a $6.3 billion capacity agreement, also a major customer. That's a circular economy that works beautifully when AI demand stays red hot and gets very messy if it doesn't. Watch this one carefully. Last company, Nebius. This was once Yandex, Russia's version of Google. The founders restructured it and built an AI-native cloud company from scratch. Nvidia put in $2 billion in March. The numbers are wild. Q1 2026 revenue up 684% year over year. A backlog of $50 billion. $27 billion for Meta, $19 billion for Microsoft. And unlike CoreWeave, their debt-to-equity ratio is a much more manageable 2.1 times. Here's the edge. Nvidia gave Nebius preferred access to the next-generation Rubin platform. GPU availability is basically revenue, so that preferential access is worth more than the $2 billion check. The risks are valuation. 47x trailing revenue is extreme for a company still losing money, and lingering geopolitical perception around the Yandex origins. But if you believe Europe needs AI compute sovereignty, Nebius is the only real play. Let's zoom out and ask, why is Jensen Huang doing this? There are 4 strategic reasons. 1. Supply security, locking up optical components before AMD or Intel can. 2. Demand creation. Every dollar invested in CoreWeave, Nebius, and Iron comes back to Nvidia as GPU purchase orders. 3. Ecosystem moat. When Nvidia is your investor, your hardware provider, and your customer, it's nearly impossible to switch to a competitor. And 4, they're funding the R&D for technologies, co-packaged optics, silicon photonics, Rubin-class compute that Nvidia needs for its own next-generation products. It's vertically integrated genius, and it's working. Now let's look at the risks of these companies. The circular economy concern is the biggest one. Nvidia is investor, supplier, and customer to the same companies. The valuation issue is real. These stocks have already made enormous moves. The Corning factory concentration is a supply chain single point of failure. CoreWeave's leverage is genuinely scary. Chip export restrictions could slow deployment globally. And long-term, if Amazon, Google, and Meta fully move to their own silicon, Nvidia's whole partner ecosystem gets disrupted. You need to know these risks before investing. Keep position sizes appropriate to your risk tolerance. All right, let's wrap it up. Nvidia isn't just a chip company anymore. With $45 billion in equity commitments in 2026 alone, Jensen Huang is building the operating system of the AI economy. The optical plays, Corning, Lumentum, Coherent, are strategic bets on Nvidia's own supply chain. High conviction, stretched valuations, but fundamentally justified by the technology shift to fiber optic AI infrastructure. The neoclouds, Iron, Nebius, CoreWeave, are higher risk, higher reward. Nebius has my favorite risk-reward profile with its $46 billion backlog and manageable leverage. CoreWeave is the most established, but also the most leveraged. Iron owns genuinely scarce power assets. The real story is this. Every single one of these investments makes Nvidia harder to compete with. AMD can make great GPUs, but can AMD match a $45 billion ecosystem flywheel? That's the bet Nvidia is making on itself. And so far in 2026, it's working. Thanks for watching. If you found this valuable, hit like, subscribe, and drop your questions or your own takes in the comments below. What's your favorite play from this list? I'll see you in the next one.